All right, let's get right into it. If you've been following the markets lately, you've got to be feeling some whiplash, right? The headlines are screaming two completely different things at once. Well, today, we're going to cut through all that noise. We're going to look at the one signal the really big institutions are watching to understand what's actually happening. Because this isn't about a crash, it's about a repricing. And this is the split screen reality right here. On one side, you have these huge banks calling for the S&P 500 to rocket to new highs. And on the other, you have global financial watchdogs waving these giant red flags, warning that a sharp, sudden drop could be coming. So who's right? Well, the real story isn't in the headlines. So first, let's talk about the good news story, the one that says the party is really just getting started. And look, this isn't just wishful thinking. This is a hard forecast from one of the biggest names on Wall Street. They're looking at strong company earnings, they're seeing that consumers are still spending, and that's painting a really optimistic picture for the months ahead. And you can see that confidence right here in their actual price targets. For the S&P 500, they're aiming for 6,000. Over in Europe, they're calling for a 9% jump. They see strength pretty much everywhere, mostly fueled by that big tech boom and this feeling that investors are just ready to buy any little dip. This is the bull case, right here in black and white. But, and this is a big but, if we stop there, we're only getting half the story. Because under that confident surface, some pretty serious cracks are starting to appear. And this warning is coming from the IMF. Think of them as the world's financial firefighter. They're looking at the exact same market and seeing something totally different. They're seeing complacency. You know that dangerous feeling that nothing can go wrong? Well, that's often the exact moment it does. So what are these specific risks that have the IMF so concerned? Well, first off, valuations are really high. Second, the whole market rally is basically being held up by just a tiny handful of huge tech stocks. If they stumble, the whole thing could ripple outwards. And then you've got the wild cards, geopolitical stuff, unpredictable trade policy, and of course, the big question of when, or even if, the Fed is going to cut interest rates. So you have bullish targets on one side and bearish warnings on the other. With all this conflicting info, what do you actually pay attention to? It turns out there's one number that cuts right through all the noise. What is the one signal that tells the big money managers when it's time to start playing defense? It's not a headline. It's not a forecast. It's about cash. Yeah, we're talking about institutional cash levels. Just think of it as dry powder. It's the cash that the world's biggest investment funds are keeping on the sidelines. It's their safety buffer, it's their war chest to buy stuff when it's cheap, and it's a direct measure of how much defense they can actually play. And that brings us to this number, 3.8%. Right now, that's how much cash institutions are holding as a share of their assets. And that is the lowest it's been in over a decade. The safety buffer? It's almost gone. Now, historically, this number is a really powerful signal. Just about every time institutional cash has dipped below that 4% line, it's triggered what analysts call a global sell signal. Now, it's not a guarantee, nothing is, but it is a very strong historical pattern that suggests stocks tend to have a rough time for the next 1 to 3 months. Basically, the market is fully invested with almost no cash left to soak up a shock. So, what happens when a shock hits a market that has no cash on the sidelines? Well, it doesn't just fall, it reprices. Let's break down exactly how that domino effect works. First off, what even is repricing? It's not a crash driven by panic. It's actually a cold, logical reevaluation. It's that moment when some new piece of information hits and everyone all at once is forced to ask, wait, is this thing really worth what we thought it was? And here's the chain reaction. First, some kind of shock hits the system. Normally, funds with dry powder would swoop in and buy the dip, which helps stabilize prices. But with cash levels at 3.8%, there is no dry powder. So instead, funds that need cash are forced to sell into a falling market, which just pushes prices down even more. And that forced selling is what triggers a really fast and painful repricing of risk across the entire market. It really just boils down to this. When there's high liquidity, lots of cash, the market is pretty resilient. Shocks get absorbed. But in a low liquidity world like we're in today, the system is fragile. Shocks don't get absorbed, they get amplified. So, okay, we've seen the conflicting stories, we've seen the underlying signal. The most important question is, what does any of this actually mean for you? I think this quote from the Economic Times just nails it. This signal isn't a reason to panic sell everything. It's a reason for prudence.
It's a wake-up call to look past that confident surface and just be aware of the real underlying risks.
So, what are the key mental models to take away from all this? First, try to focus on the real signals, like these cash levels, not just the noisy daily headlines. Second, understand that when everyone is all in and liquidity is low, the whole system is just more fragile. Third, start to see corrections not as some random crash, but as a repricing of risk. And finally, remember that liquidity. Whether you're a giant fund or just you, liquidity is what gives you flexibility to navigate whatever comes next.
So there you have it. We've laid out both sides of the market and the one key signal that could decide which story wins out. Now that you've seen that signal flashing red, the real question isn't whether you should be bullish or bearish. The question is, what will you be watching for now?